You pay interest on your car. You pay interest on your home. You pay interest on purchases you made 3 years ago and forgot about. Every month, money flows out of your bank account and into institutions you will never see. You call this normal. Your parents called it normal. Their parents called it normal. It was not always normal. 5,000 years ago, charging interest on a loan was a crime punishable by death. The great religions banned it. Philosophers condemned it. Kings periodically wiped all debts clean because they understood something modern economists prefer you forget. Debt, left unchecked, concentrates wealth until societies collapse. Today, debt is not a crime. Debt is a $315 trillion industry, the largest asset class on Earth, more profitable than oil extraction, more profitable than pharmaceutical patents, more profitable than every technology company combined. This transformation did not happen by accident. It was engineered across 50 centuries by priests who found loopholes, bankers who invented new instruments, and governments who discovered they could borrow forever. The machinery they built extracts wealth from you every single day. Oil made nations rich. Debt made institutions untouchable. The distinction matters. Oil sits in the ground. Someone must find it, drill it, refine it, ship it, sell it. The supply runs out, the infrastructure degrades. The profits depend on physical labor and geological luck. Debt requires none of this. Debt multiplies through bookkeeping entries. Debt generates returns while bankers sleep. A single loan issued in 1694 is still generating profit for its holders today. No oil well has ever done this. No factory has ever done this. No product in human history has ever achieved what debt achieves. The flow of interest payments creates permanent extraction. The concentration of lending power creates structural gatekeepers. The infrastructure of credit markets creates leverage over every person who needs money they do not have. And in modern economies, everyone needs money they do not have. This is not an accident. This is the system working as designed. This is Noob Historian. History has owners. We name them. The reason you carry a mortgage, a car payment, student loans, and credit card balances is not because you made poor decisions. It is because you were born into an economy where participation requires borrowing. The price of a home exceeds what any normal salary allows you to save. The cost of education exceeds what any student possesses. The gap between what you earn and what life demands is filled by debt. Someone profits from this gap. Someone designed this gap. The annual interest you pay funds the bonuses of executives you will never meet. The late fees you trigger cover the operating costs of institutions older than your country. Your financial life is a revenue stream. This video traces how humanity built this system. We examine the clay tablets where the first interest rates were recorded. We follow the legal codes where debt bondage was institutionalized. We watch medieval bankers invent instruments to charge interest without calling it interest. We document the exact moment governments discovered permanent borrowing. We track the 20th century innovations that put credit cards in every wallet and mortgage debt in every household. By the end, you will understand how debt became the most profitable product ever invented. You will understand why breaking free from it is so difficult. And you will see the mathematical problem at the heart of a system built on infinite growth in a finite world. The earliest evidence of debt comes from Sumer in what is now southern Iraq. Between 3500 and 3000 BCE, temple administrators began recording obligations on clay tablets. These tablets survive by the thousands in the Yale Babylonian Collection and the British Museum. They document humanity's first experiments with credit. The Sumerians developed writing not for poetry or history. They developed writing to track debts. The earliest tablets record quantities of barley owed to temples. Farmers borrowed seed grain in the spring and repaid after harvest. The interest rate was standardized at 33% for grain loans. This rate persisted for nearly 2,000 years across multiple empires. It was not arbitrary. It reflected the agricultural calendar. Borrow 1 bushel, plant it. Harvest 3 bushels. Return 1 1/3. Keep the rest. Silver loans carried different terms. The standard rate was 20%. Merchants borrowed silver to fund trading expeditions. They repaid from profits. The interest reflected risk. Not every expedition succeeded. Not every merchant returned. These rates became embedded in the Code of Hammurabi, inscribed around 1754 BCE. This Babylonian legal code contains 282 laws. 35 of them regulate debt, interest, and collateral. The code specifies maximum interest rates. It defines the rights of creditors and the protections of debtors. It establishes procedures for debt disputes. One law stands out. If a creditor charges more than the legal maximum, the creditor forfeits the entire loan. The state did not merely regulate lending. The state punished predatory lending with total loss. Hammurabi understood something modern regulators have forgotten. Uncontrolled debt extraction destabilizes societies. When too many farmers lose their land to creditors, food production falls. When too many citizens fall into debt bondage, the tax base shrinks. When too many families fracture under financial pressure, social cohesion fails. The solution was the debt jubilee. Sumerian kings periodically declared amargi. This word appears on the oldest known inscription about freedom. It means a return to the mother. In practice, it meant debt cancellation. All consumer debts were wiped clean, all debt slaves were freed, all foreclosed land returned to original families. Babylonian kings continued this practice under the term andurarum. New kings typically declared a jubilee upon taking the throne. The policy served multiple purposes. It generated popular support for the new ruler. It prevented the permanent concentration of land in creditor hands. It reset economic imbalances before they became catastrophic. The tablets reveal something profound about ancient attitudes toward debt. Lending at interest was accepted, regulated, and periodically erased. The ancients treated debt as a tool with an expiration date. They built reset mechanisms into their economic systems. Modern economies have no such mechanisms. The transition from periodic jubilees to permanent debt began in the ancient world and accelerated through Rome. The legal innovations of these early creditors created frameworks still embedded in modern law. When you sign a loan document, you enter a contractual relationship whose basic structure was defined 4,000 years ago in Mesopotamian courtrooms. Roman debt law created the template for modern credit systems. The concepts Romans developed to regulate lending persist in legal codes across the Western world. The Latin terms they coined remain in use by lawyers today. The problems they encountered repeat in every debt crisis of the modern era. Early Rome practiced debt bondage in its most brutal form. The system was called nexum. A borrower who failed to repay became the physical property of the creditor, not a servant, property. The creditor held legal right to chain the debtor, force labor, and sell the debtor into foreign slavery. The 12 Tables, Rome's foundational legal code from 450 BCE, specified the procedures. A creditor had to bring the debtor before a magistrate. The magistrate confirmed the debt. The debtor received 60 days to find payment. If no payment came, the creditor took possession. One law in the 12 Tables reveals the severity. If multiple creditors held claims against a single debtor, they held the legal right to kill the debtor and divide the body proportionally to their claims. Historians debate whether this law was ever enforced. Its existence on the books tells you everything about creditor power in early Rome. The nexum system created social crisis. Debt-enslaved citizens could not serve in the legions. Military manpower declined. Political tensions rose between creditor patricians and debtor plebeians. The result was revolt. In 326 BCE, the Lex Poetalia abolished debt bondage for Roman citizens. Creditors retained rights to debtor property. They lost rights to debtor bodies. This single law represents one of history's most significant shifts in the balance between creditors and debtors. Rome then developed sophisticated alternatives to physical bondage. The legal concept of mutuum governed consumption loans. The borrower received fungible goods like money or grain. The borrower owed back an equivalent quantity. Interest was handled separately through a stipulatio, a formal verbal contract witnessed by both parties. Interest rate caps evolved through Roman history. The Lex Genusia of 342 BCE prohibited interest entirely, though enforcement was weak. The standard ceiling was 12% annually, called the centesima. Provincial loans sometimes reached 48%, reflecting higher risk in distant territories. Roman law also developed the concept of compound interest and its prohibition. Anatocismus, the practice of adding unpaid interest to principal and charging interest on the total, was banned in most circumstances. Roman jurists understood the mathematical danger. Compound interest grows exponentially. Debts subject to compounding quickly exceed any borrower's ability to repay. The great Roman debt crises demonstrate the pattern. In 33 CE, during the reign of Tiberius, a credit crisis paralyzed the empire. Creditors called in loans, debtors sold assets. Asset prices collapsed. The selling triggered more calls, more sales, more collapse. Tiberius responded with what modern economists would call a bailout. The treasury provided 100 million sesterces in interest-free loans to stabilize the credit markets. The state became lender of last resort. This playbook would be repeated in 1907, 1929, 2008, and 2020. Roman legal innovations passed into the Corpus Juris Civilis, compiled under Emperor Justinian in the 530s CE. This compilation preserved Roman law through the medieval period. When European universities revived legal studies in the 1100s, they studied Justinian's texts. The debt concepts you encounter in modern contracts trace directly to these Byzantine compilations of Roman originals. The structure of obligation, the enforceability of interest, the remedies for default, the role of witnesses and documentation. All of this architecture comes from Rome. When a modern court enforces a loan agreement, it applies principles Roman jurists debated 2,000 years ago. For 1,000 years, the Christian church banned charging interest on loans. The prohibition was absolute. The penalties were severe. Usurers faced excommunication, denial of Christian burial, and eternal damnation. The church grounded its position in Scripture. Exodus 22:25 forbade interest on loans to the poor. Deuteronomy 23:19 prohibited interest between fellow believers. Luke 6:35 commanded lending without expecting return. The prohibition also rested on Aristotle's argument, transmitted through Thomas Aquinas, that money was sterile. Money could not breed. Charging for the use of money was therefore unnatural. The ban posed a practical problem. Medieval economies needed credit, merchants needed capital for trading expeditions, kings needed funds for wars, farmers needed loans to survive between harvests. The demand for credit never diminished, only the supply faced restriction. Into this gap stepped Jewish lenders who faced no prohibition on lending to Christians. Their role generated resentment and persecution. More significantly, it generated innovation. Christian merchants, watching Jewish lenders accumulate profits, developed legal mechanisms to share in those profits without violating church law. The bill of exchange was the breakthrough. A Florentine merchant gives money to a banker in Florence. The banker provides a written bill instructing the banker's correspondent in London to pay an equivalent amount in English currency. The Florentine travels to London and collects. Where is the interest? Nowhere explicit. The exchange rate between Florentine florins and English pounds includes a premium. This premium compensates the banker for the service, the risk, and the time value of money. It functions as interest. It appears as currency conversion. Church authorities debated these instruments endlessly. Theologians wrote treatises distinguishing legitimate exchange profits from disguised usury. The distinctions grew increasingly fine. The bills continued trading. Italian banking families mastered these instruments. The Bardi and Peruzzi of Florence dominated 14th century finance until English royal defaults destroyed them. The Medici rose in their place. The Medici Bank, operating from 1397 to 1494, left complete records in the Florentine archives. These ledgers document the most sophisticated financial operation of its era. The Medici did not call themselves bankers. They called themselves exchange dealers. Their profit came from moving money across borders, not from interest on loans. The ledgers tell a different story. Medici profits averaged 20 to 30% annually. Exchange fees alone could not generate such returns. The records show creative accounting, penalties for late payment, fees for services rendered, profit-sharing arrangements structured to guarantee the bank's return regardless of business outcomes. The Medici Bank operated branches across Europe: Florence, Rome, Venice, Milan, Geneva, Bruges, London, Avignon. Each branch maintained correspondent relationships with the others. Money deposited in one city became available in another. The network created the first international credit system. The Medici also pioneered relationship banking. They served the papacy as primary bankers, collecting church revenues across Europe and concentrating them in Rome. This relationship provided both profit and protection. Who would prosecute the Pope's bankers for usury? Lorenzo de' Medici, the famous patron of Renaissance art, was a terrible banker. Under his management, the bank contracted and weakened. After his death in 1492, the bank collapsed entirely. But the innovations his family developed survived: bills of exchange, correspondent banking, international credit networks, double-entry bookkeeping. These tools spread across Europe and formed the infrastructure of modern finance. The Church gradually accommodated reality. The Fifth Lateran Council in 1515 approved the Montes Pietatis, charitable pawnshops that charged interest to cover operating costs. The Reformation shattered church authority entirely. Protestant theologians reinterpreted Scripture to permit lending at moderate interest. John Calvin explicitly approved interest up to 5%. By 1600, the prohibition on usury was dead in practice across most of Europe. The infrastructure for what came next was already built. In 1694, the English Parliament faced a problem. King William III needed money to fight France. The royal treasury was empty. Previous loans had been repaid poorly, or not at all. No one would lend to the crown. A Scottish merchant named William Patterson proposed a solution. He would organize a group of wealthy investors to lend the government $1.2 million. In exchange, the investors would receive 8% annual interest plus $4,000 yearly for management expenses. They would also receive the right to incorporate as a bank and issue banknotes. The Bank of England was born from this loan. The original subscription books survive in the Bank of England archive. They list 1,268 initial investors who provided the capital. The subscribers included merchants, aristocrats, and members of parliament. Many had direct interest in the war the loan would fund. The structure was unprecedented. Previous government loans had specific repayment dates. This loan had none. The government promised to pay interest indefinitely. The principal would remain outstanding forever unless the government chose to repay it. This was permanent national debt. The innovation transformed government finance. Previous kings borrowed for specific purposes and repaid from specific revenues. They operated within natural limits. They could only borrow what they could eventually repay. Permanent debt eliminated this constraint. The government no longer needed to repay. It only needed to service the interest. As long as tax revenues covered interest payments, the debt could grow without limit. The bondholders loved this arrangement. They received guaranteed income streams lasting generations. They could pass bonds to their heirs. They could sell bonds to other investors. The secondary market meant they never waited for government repayment. They sold to the next buyer whenever they wanted cash. The Dutch had pioneered these techniques earlier. The province of Holland sold perpetual bonds in the late 1500s. The Dutch East India Company issued transferable shares and bonds in the 1600s. The Amsterdam market developed sophisticated trading and government obligations decades before London, but England took the model further. The Bank of England became the government's permanent banker. New loans funded new wars: William III's war with France, the War of Spanish Succession, the endless conflicts of the 18th century. Each war added to the national debt. Each edition increased bondholder income. The numbers grew astonishing. English national debt stood at $16 million in 1697. It reached $78 million by 1750. It hit $245 million by 1783. The American Revolution alone added over $100 million to British obligations. Surely the nation could not foresee how economic growth would expand the tax base. They could not anticipate how inflation would erode the real value of fixed-rate debt. They did not imagine central banks creating money to purchase government bonds. The Bank of England model spread across Europe. France created similar institutions. So did Prussia, Austria, and eventually every major nation. The template established in 1694 now governs sovereign borrowing worldwide. The original $1.2 million loan was never repaid. It was converted, consolidated with other debts, and rolled into new instruments. The descendants of those 1,268 original investors continued earning interest on government obligations for centuries. Some of those family fortunes persist today. For most of human history, debt was the province of kings, merchants, and farmers. Ordinary workers borrowed in emergencies and repaid as fast as possible. The idea of permanent consumer debt, carried as a normal feature of household finance, did not exist. The 20th century changed everything. The transformation began with installment credit. Singer sewing machine pioneered the model in the 1850s. The machine cost more than most families could pay at once. Installment payments made purchase possible. Singer built an empire, selling machines and collecting interest. The automobile accelerated the shift. In 1919, General Motors created the General Motors Acceptance Corporation to finance car purchases. Ford initially resisted, believing customers should save before buying. Ford lost market share. By 1926, Ford also offered financing. By 1929, Americans had discovered they could buy now and pay later. Installment debt financed automobiles, appliances, furniture, and radios. The stock market boom ran partly on borrowed money. Margin accounts let investors buy stocks with 10% down. The crash revealed the danger. When prices fell, margin calls forced sales. Forced sales pushed prices lower. The spiral continued until markets lost 89% of their value. Household debts remained even as income vanished. The Depression taught a generation to fear borrowing. Their children forgot the lesson. The modern credit card was invented in 1950. Frank McNamara, a New York businessman, founded Diners Club after an embarrassing dinner where he lacked cash to pay his bill. The Diners Club card was a charge card requiring full payment each month. It was not yet a debt instrument. Bank of America transformed the model in 1958. The Bank Americard, later renamed Visa, offered revolving credit. Cardholders could carry balances month to month. Interest accrued on unpaid amounts. The interest rate was 18% or higher. The Fresno drop of 1958 demonstrated the marketing strategy. Bank of America mailed 60,000 unsolicited credit cards to residents of Fresno, California. No application required, no credit check. The cards arrived activated and ready to use. The result was chaos. Fraud was rampant. Defaults were high. Bank of America lost money in the first year, but the strategy worked. Customers kept the cards. Customers used the cards. Customers carried balances. The mass mailing of unsolicited credit cards continued until Congress banned the practice in 1970. By then, the credit card was established in American life. The real explosion came from securitization. Before securitization, banks made loans and held them. The bank's capacity to lend was limited by its deposits. If a bank had $100 million in deposits, it could make roughly $100 million in loans. Securitization broke this constraint. The Government National Mortgage Association, called Ginnie Mae, guaranteed the first mortgage-backed security in 1970. The security bundled thousands of individual mortgages into a single tradable instrument. Investors bought the security. The bank got its money back. The bank could make new loans. Fannie Mae and Freddie Mac expanded the model. Private banks created their own mortgage securities. The market grew from nothing in 1970 to over $11 trillion by 2008. The implications were profound. Banks no longer cared whether borrowers could repay. Banks sold the loans immediately. Risk passed to investors. Volume became the only goal. More loans meant more fees. Credit standards collapsed. The 2008 financial crisis was the direct result. Mortgage securities built on worthless loans collapsed in value. Banks holding these securities faced insolvency. The global financial system froze. Governments responded with bailouts. The U.S. Federal Reserve purchased over $4 trillion in mortgage securities and government bonds. Central banks worldwide did the same. The financial system survived. The debt remained. Household debt in America reached $17.5 trillion by 2024. This includes $12.1 trillion in mortgage debt, $1.6 trillion in auto loans, $1.1 trillion in student loans, $1.1 trillion in credit card balances. Every dollar of this debt generates interest income for lenders. Every dollar represents a claim on your future labor. The system built across the 20th century ensures you spend your working life paying for purchases already made. The global debt market now exceeds $315 trillion. This figure represents 331% of world GDP. In simple terms, humanity owes more than 3 years of total planetary economic output. The number breaks down across sectors. Government debt exceeds $92 trillion. Corporate debt exceeds $90 trillion. Household debt approaches $60 trillion. Financial sector debt makes up the remainder. At current population, global debt equals approximately $39,000 per person. This includes children, the unemployed, the impoverished. Every human being on Earth carries this statistical burden. The United States demonstrates the pattern at national scale. Federal debt exceeds $34 trillion. Annual interest payments on this debt now exceed $1 trillion. This interest payment is larger than the entire defense budget. It is larger than Medicare spending. It is larger than all non-defense discretionary spending combined. Every year, over $1 trillion flows from American taxpayers to holders of government bonds. The bondholders include domestic banks, pension funds, foreign governments, and wealthy individuals. This is wealth transfer on an unprecedented scale. Corporate debt has tripled since 2008, exceeding $13 trillion in the U.S. alone. Companies borrowed at low rates to buy back stock, fund acquisitions, and pay dividends. The borrowed money did not build factories. It did not fund research. It enriched shareholders and executives. Now interest rates have risen. Corporate debt service costs are climbing. Companies with heavy debt loads face difficult choices. Cut workers, cut investment, raise prices, default. The financial industry profits from every layer of this system. Banks collected $574 billion in net interest income in 2023. This represents the difference between what banks pay depositors and what banks charge borrowers. It is pure extraction from the spread between rates. Fees multiply the profits. Loan origination fees, servicing fees, late payment fees, overlimit fees, balance transfer fees. Credit card issuers alone collected $14.5 billion in late fees during 2023. The securitization process adds more layers. When your mortgage is securitized, fees go to the originating bank, the securitizing bank, the rating agency, the trustee, the servicer, and the trading desks that buy and sell the securities. A single mortgage may generate fees for 15 to 20 different entities before you finish paying it. Financial sector profits have risen from 10% of all U.S. corporate profits in 1950 to over 40% by 2007. The industry that produces nothing tangible now captures nearly half of all business profits in the largest economy on Earth. The system depends on perpetual expansion. Each dollar of GDP growth now requires approximately $4.50 of new debt creation. In the 1970s, the ratio was $1.50. The diminishing return is unmistakable. More and more borrowing produces less and less growth. This trajectory cannot continue forever. Compound interest is exponential. Economies grow at linear or polynomial rates. Eventually, exponential growth exceeds any finite base. History shows the resolution patterns: debt jubilees in ancient Mesopotamia, defaults and banking collapses in medieval Europe, hyperinflation in Weimar Germany, restructuring in Latin American debt crises, bailouts in 2008. Each resolution destroys wealth somewhere. Jubilees destroy creditor wealth. Defaults destroy investor wealth. Inflation destroys saver wealth. Bailouts transfer wealth from taxpayers to financial institutions. The current moment feels stable because interest payments remain serviceable. Global central banks spent 2022 and 2023 raising rates from 0 to 5%. This was the fastest rate increase in 40 years. Debt service costs are rising throughout the economy. Governments must choose between debt payments and public services. Corporations must choose between debt payments and wages. Households must choose between debt payments and consumption. These choices will shape the coming decade. You exist within this system. Your mortgage payment includes interest transferred to bondholders. Your credit card balance generates fees for bank executives. Your student loans fund the education of future borrowers, not your own benefit. Your taxes service federal debt before they fund services you use. Understanding this history gives you no escape, but it does give you clarity. The money flowing out of your accounts each month is not friction. It is not overhead. It is the primary product of the largest industry ever constructed. Debt has owners. You have now learned their history. The question remaining is what you do with this knowledge in an economy designed to keep you borrowing until you die.